Back on Economic Buzz, this program can also be seen through StarHub Asia Channel 121 Singapore with me, Vicky Adrian, and Mr. Vicky Amarnani, market strategist, Monex, invest in the futures. So gold is no longer the safe haven.
Yeah, gold has lost its safe haven appeal as soon as it broke 1,520 this year. So basically what we need to understand is what is the safe haven investment now is US dollar. If you see every time when there's a panic, there's a sell-off in equities, bond markets are falling, it is the dollar that is strengthening basically. I mean, few currencies, the euro has strengthened a little over the dollar, but if you look especially for emerging markets, the dollar has strengthened.
Yeah. So for the long-term investment, how do you see gold as the, I don't know, one of the commodities that maybe can we can buy or we can get into the gold or
well, yes. The thing is with gold, I mean, sometimes, you know, when times are negative, there's a bit of correction. People think, oh, gold is going to go to 800, 1,000. No, I don't believe gold should drop to those extreme levels. I think there already has been big physical buying from India, Russia, and certain countries for gold, even by governments. But I see if I believe gold will test a new low. The $1,320 will break, but at the levels of about $1,200 to $1,250 for physical buyers, even for traders, it's a good entry point for gold. Because at the end of the day, yes, I mean, as much as we say, you know, dollar will strengthen, you know, gold is no more a safe haven. It is a certain hedge against inflation. Gold price, I mean, it's a natural resource. It's a scarce resource, basically. The whole world wants to buy gold. It's just a certain sentiment has changed. So it doesn't mean that gold will just keep on crashing. So my suggestion for gold is, if you are physical buyers, even at these levels you can buy, as long as your view is for holding gold over 3 years. But if you're a trader, don't fight the downtrend. Now, just go with the flow. Just go with the flow. In fact, on a rebound, sell gold. I don't see gold breaking a high of 1,520. 1,520, which was a very strong support, has become a very strong resistance. And any rebound to the 1,430 to 1,450 levels is a sell for traders, people who trade online. But for physical buyers, go ahead and buy now, long term. At 1,200, 1,250, if you see those levels, I mean, I would just say shut your eyes and buy gold.
So is it going to be a long term? I mean, if you're talking about the correction moment for gold.
Yes, I mean, if you're buying gold and expect gold to go up in the next 6 months, you know, and make good 20% return, I think that you'd rather be a trader. But if you're just buying physical gold and you're more long-term, you know, trying to diversify your portfolio, a little into cash and commodities, a little into some other investments, maybe your core businesses, then yes, physical gold buying is...
Amid this thing, so-called global crisis, every country has their own regulation to, I don't know, to grow their export number. As we know, Japan has already have their own regulation to weaken their yen. So how do you see this? Actually, is it going to be the thing that maybe other country will do also to protect their economy?
Well, I mean, if you see it, it's already the one who implemented it first was US. They reduced those interest rates from 5.25% all the way down to 0.25. They started doing the asset buying, buying their bonds back, so yields remain low, interest rates remain low. It supports the market basically with good liquidity. That's number one. Then Europe has been following that. Even China basically has been cutting rates. If you look, the whole world has actually been cutting rates to provide more easing to the market. And there's been purchasing programs from the UK, from Europe, from US. And US and Japan has just recently done it in a very aggressive way. I mean, they have said that they will basically print as much money required or as the asset buying program they have now until their interest goes up to 2%. Until, basically, because now inflation, I meant to say, inflation 2%, because now they're under deflation. So they can keep on printing. I mean, a country that's under deflation doesn't have inflation worries at this point. So them doing this quantitative easing, asset buying program, weakening the yen is very supportive for an export-oriented country. Because every 1 yen weakened, for example, let's say if the dollar yen weakens from 98 to 99, every 1 point is an extra profit of $125 million for Toyota. So all these companies benefit because their production is all in Japanese yen. Their profits are in US dollars. So if their production becomes cheaper because the currency is weaker, and their profits increase because they get the currency which is appreciated against the local currency, that is beneficial for the economy, beneficial for the index, and that's very good step that the Japanese have taken, I would say following the US and the Europe as well.
Okay.
I mean, that's how US has come out of the recession, or there's been a good recovery or a moderate recovery, and job growth is improving, manufacturing index is at more better levels, consumer confidence improving, because government needs to stimulate the economy. If the government doesn't stimulate and everybody keeps their money under their pillows, then we're going to face a recession.
Yeah. Okay, so the possibility in currency war, how do you see this?
Yes, I mean every country wants their currency to be as weak as possible for export benefits and other purposes. But let's take China as an example. China has continuously appreciated. I mean, Chinese yuan now is basically about 6.15 to the US dollar. So it has slowly appreciated, because when an economy improves, the currency needs to appreciate. I mean, that's how you have urbanization, healthy economy, modernization, and good infrastructure as well for the economy. When there's good growth with good currency strength, so people are interested in investing into your country as well. But this is what is not happening with emerging markets, because they have fear of slower growth. But then they have to understand that with slower growth and high inflation, they can come into a problem of stagflation.
So it's getting interesting. We're going to continue after the break.
Sure.
Yeah, make sure that you're still with us on Economic Buzz. After this, we have some macroeconomic informations that have a relation with our topic today. Stay tuned with eBuzz.